Welcome to EAGTAX and our tax advent calendar, where we will be sharing tax tips and explanations in the lead up to Christmas. For day 8, we will explain what capital allowances are. While some costs are immediately deductible through the profit and loss account, tangible assets which are recognised within the balance sheet generally do not receive immediate tax relief unless they qualify for capital allowances. The special rate expenditure pool includes integral features, high CO2 emitting cars, thermal insulation and solar panels. The balance of equipment, machinery, fixtures and fittings will enter the main pool. There is also a short life asset pool, which is useful if you've utilised your 100% allowances and expect to either scrap or sell the asset for very little value. After an 8-year period, it will transfer automatically into the main pool. Once you have determined which pools to use, it is then a matter of considering how to obtain tax relief for the costs included. The annual investment allowance writes 100% of the expenditure off in the year of acquisition. In the recent 2022 autumn statement, the government set this allowance at £1 million for the foreseeable future. First-year allowances have a similar effect to the AIA and are available for specific types of expenditure, such as cars with no CO2 emissions and zero-emission goods vehicles, electric vehicle charge points, machinery, plant and equipment used in Freeport sites, research and development allowances, the temporary 130% super deduction and 50% SR allowance, both which are set to end on the 31st of March 2023. Expenditure not written off in the first year is then subject to writing down allowances. Assets in the main pool attracting an 18% writing down allowance and 6% in the special rate expenditure pool. If the asset is sold for consideration, this value will enter the relevant pool, reducing the amount available to be written down or creating balance in charges, which both have the effect of increasing taxable profits. As a general rule, land and buildings do not qualify for capital allowances. However, the Structures and Buildings Allowance was introduced in 2018 to provide low-level tax relief for commercial buildings. When acquiring a commercial building, it is important that your property solicitor consider and negotiate the Section 198 election. This is in relation to fixtures. The vendor responses contained within the CPSC1 pre-contract inquiry document will assist with this conversation. Ultimately, it is your decision to claim capital allowances within your business, and there is certainly a lot to consider when investing in qualifying assets. We hope you found this useful. Please take a look at our website for more information and contact details at eagtax.co.uk.